So this episode, this is the third episode on elements to a trade setup. Okay, so we are talking about price trading below and the opening candle of the day. Okay, for our high probability buy entry. Okay, so please, if this is the first video you are watching on this channel, you might want to check out the first and second videos before watching this one to get a proper understanding on Dick's teaching. Okay, so price trade below the opening candle for the day and grabs and trade below an old low just after the New York launch hour. Okay, that is the 12 p.m. to 1 p.m. Okay, so price grabs liquidity. So now we are going to go down to let's go down further into much details on this price action right here. Okay, now as you can see, this is the opening candle right here, and price trades below it. This is the 1 hour time window for the New York launch hour. Okay, this is 12 p.m. to 1 p.m. and as you can see, price came down and formed a kind of short-term low right here and another short-term low. Okay, creating some kind of support level, and as you can see, price drops down below the support level, and this short-term low right here is having sell stops below it, right below it, sell side liquidity. Okay, so price dropped down and moved away and spun higher aggressively, and there was a break of structure here. Okay, so what we do now, whenever we come across a kind of situation like this, stops have been run out. Okay, price expand higher and a break of structure has happened. Okay, so and going back upwards to the 15-minute time frame, once we see once price breaks or take out a level of significant stops, okay, a short-term low or short-term high, remember we said if we are anticipating a move higher in price, we should expect some level of stop or some level of run on sell side liquidity. Okay, so once that happens, all you have to do is to drop down to the 5 minute 5 minute time frame, 3 minutes, 4 minutes, 1 minute time frame to hunt for your imbalance and break of structure. Okay, now what we are going to do now is we are going to pretend that none of this has happened yet, and we are just sitting in front of our chart, and price has just traded down below an old short-term low. Okay, below an old short-term low, which tends to have sell side liquidity resting below it, which is sell stops. Okay, price drop down. So what we are going to do, we are going to go down to our lower time frame, 5 minute time frame, to hunt for a break of structure and probably imbalance. Okay, so now here we have the 5 minute time frame. This is price trading below that old short-term low. Okay, taking out the sell stops resting below this old low, and now we see price trade up and taking out this short-term high as a break of structure. Okay, now we are bullish from this point, we are bullish here now. So what we do now is we hunt for a fair value gap created after the break of structure. Okay, we wait for price. So now we have this high probability entry based on the fact that uh on the fact that one, we are currently below the opening candle of the day, okay, and we know that our directional bias is bullish, so we are looking for buy entry, we are looking to go long, okay. So now price trades below the opening candle for the day, and we are price after, we are outside the New York rush hour, okay. We are outside the New York rush hour, and price just trades down below an old short-term low, and we know that we are aware that whenever we are anticipating that price should go up, we should see some level of short-term low be taken out, and which is exactly what happened here. So price trade down below this short-term low, taking out this sell stops, sell side liquidity, and we wait for a break of structure to indicate that price that the trend has changed, okay, and which is what happened here. Price broke structure. So now we are going to pretend that none of this from here has happened, okay. We are using the benefit, remember we are using the benefit of hindsight, okay. So now we are going to pretend that none of this has happened yet, and price has just broke structure to the top, okay. So now we are going to look between this price leg, we wait for a retracement. Once this retracement start happening, then we can go into this price leg right here, from this high to this low, for imbalance, for fair value gap created when price breaks when price broke this structure, okay, when price breaks structure upwards. So now if we are to look in, we zoom in right now, okay, we are going to see that price created a fair value gap right here during the process of expanding upwards, which price breaks structure right here, okay. You can see that price created an imbalance right here, okay. So now price started retracing retracing downwards into this trading range, okay. Price started retracing backwards, so we'll mark out this fair value gap. Once price comes back, trades below the first candle, or rather the third candle's low of this fair value gap, there is our buy entry, okay. So we are going long here, and our stop loss is going below this short term low, okay. This short term low, our stop loss is going below this short term low. So now we wait, and as you can see, price panned out nicely, okay, and we hit our TP here. So now the reason for this red box here projecting my TP is based off your own I can't teach you how am I going to put it. Projecting your TP should be we hope when we go long, what you can see here, you see equal highs here, okay, and what is resting above this equal high is buy side liquidity, okay. So you can just project for old highs, or what I did here was I took the range of the movement below the opening candle. I measured the range out, and I duplicated it upwards, okay. I measure the range, the range of the movement below the opening candle for the day, and I cloned it and projected it upwards and use it for my as a TP, okay. And you can see as well equal highs. So what will be resting above this equal highs is buy side liquidity, okay. So price traded nicely and hit our TP right there, okay. So okay, now projecting, going down further, even further to the 3-minute time frame on the same price action data. Okay, we can see this is the 15 minutes, this is the New York launch hour. Okay, and this is the short-term low that was taken out here, and as you can see, this is a swing high right here. We have a candle high, a higher candle in the middle, and a candle's high lower than the one in the middle. That's a swing high. Okay, so the market broke structure, so we can call this is break of structure. So the market broke structure and moved away aggressively. Okay, now if coming back, market started retracing lower. So what we do, we look inside this range from this low to this high. We looked inside for fair value gaps. Okay, you can see one here, this is a fair value gap, candles high. You can see that the between this candles high and this candles low, there's a gap in between, just a single pass through, and this is another fair value gap here. Okay, you can see we have between these candles high and these candles low, there's a gap. So this is our entry. Okay, you can use this as your entry, and our stop loss will probably be below this swing low. Okay, for more safety, and to take precautions, it can be below this short-term low, which is also below uh, uh, below the which is also the short-term low created by the stop hunt taking out sell side liquidity. So price should not trade below this short-term low. Okay, and from what we can see here, price dips down below the fair value gap a bit and expand higher nicely. Okay, so using the 5 minutes, and we can see here, this is the 5 minutes chart, and we got our entry here, our stop loss here, and same thing goes for the 3-minute chart. So but what I advise strongly, and what I was taught by ICT, if you get, let's say, the run on the buy side liquidity or sell side liquidity, sorry, we went down to the 5-minute time frame, we were able to identify our fair value gap here, right here on the 5-minute time frame. There should be no need of going down to a lower time frame than that, to a time frame lower than that. What I mean is that if you are able to identify your fair value gap on the 5-minute time frame, there should be no need on going down to the 3-minute time frame to look for other kind of to look for another rather. Okay, you can just stick to the 5-minute time frame and use it as your entry. Okay, but I'm just doing this for teaching purposes. Okay, so you don't have to go down further, you can just take your entry on the 5-minute, and you can see we have same thing here, same scenario here, break of structure, market trade expand higher, started retracing, we got our fair value gap, our entry will be right here, and markets expand higher, came back, and went higher further. Okay, so now adding the Fibonacci retracement. Okay, and we use the Fibonacci retracement for premium and discount market. Okay, now breaking down this market to a premium and discount market, because price moves from a level of premium from a level of discount to premium to discount. Okay, so it's vice versa. So now taking this further on the 3-minute time frame. Okay, so now what I'm going to do right now, what we are going to do is that we are going to pretend that none of this has not happened. With benefit of hindsight, none of this has happened. We are going to ignore this price data. So now price on the 3-minute time frame, price broke structure, as you can see right here. Okay, break structure and started retracing. So now for when the market started retracing, this is known as a swing high, because it is the turning point of the market. This is where the market started turning around, and it's just a 3 candle formation. Okay, this is how we know that the market has started or is about turning around. Okay, so swing high and swing low are like the turning points of the market. So now they are just a 3 candle pattern. A candle that has a high, candle that has a candle that has a high and 2 lower highs to the right side and to the left side of it. Okay, that is a swing high. Then for a swing low, a candle that has a low and a higher low to the left and to the right side of it. Okay, this is a swing low. This is where the market turned around and started trading upwards, and this is where the market turned around and started trading downward. So once we see these 3 candles form, we can anticipate that the market is turning around. Okay, the market is turning around. So now what I'm trying to say in essence is that when the market breaks structure here, we are just we are watching price until these 3 candles pattern happen. So now we are sure that the market has turned around. So and the retracement is happening. When price is expanding, we don't do nothing, we don't chase this, we wait for it to retrace. Okay, so now price is retracing back into this trading range. This trading range is simply the low to the high. So what we do, we take out our Fibonacci retracement tool, and we take the measurement from the low to the high, and as you can see, above the 50% level is the premium, and below the 50% level is equilibrium. Okay, so now if we are looking to buy this market, we are going to be buying at discount and sell at a premium. We buy at discount and sell at premium. Okay, if you are not conversant with premium and discount concepts, if you are not conversant with this concept, you can leave a comment, and I will definitely create a separate video explaining it further. Okay, or you can as well check out ICT's channel. It has tons of video on it. Okay, so now price breaks structure here and started trading, expanding higher, break structure, expanding higher. We are watching price until we saw this 3 candle formation, and we know yes, the retracement is about to happen. So price started retracing. So we are not looking for any entry until we are not looking to buy this market until we enter, until we trade, until price trades into discount market environment. Okay, so we are still, price is still above, so we are still in a premium market environment. Okay, price drop immediately. Price dropped below the 0.50 Fibonacci level. Okay, then we can start looking for our discount array. Okay, where we can buy the market from. Okay, at a discount price. So this is why I didn't use the fair value, the first value gap we saw here, the first fair value gap we saw here. Okay, this is why I didn't use it as an entry, because this fair value gap is a little bit above the above the 50% level, and it is found in the premium environment. Okay, so I was much more interested in this fair value gap because it is below the 50% level and in a discount price, in a discount environment. Okay, so that's why it's okay. Price, this fair value gap is below the 50% level, which is a discount market environment, and that was why I was much more interested in this than the first fair value gap. Okay, so now that is how we divide the market, the trend, a range to a discount and premium market. Okay, so we'll hope to buy at discount, I will sell at premium. Okay, so now let's say you missed this first entry. Okay, we are still on the 3-minute time frame. Let's say you missed this, you were not able to get this. Okay, we are not able to get this. So now you wait let's say this whole move you were not around, or you were not able to get it, or you got in here, right here, okay, and price straight back down and we're just moving up, and another break of structure occur right here, okay, this is another break of structure right here, price broke structure upwards, and we wait for it to show, for price to give us if a read that is about to retrace, that the retracement is about to happen, which is what we got here, swing high, okay, and price started to this down. So once this happen, we take our fib and we measure it, okay, from the low to the high, and we get our 50% level right here. So we are only interested in buying this market once it trades below the 50% level. So we are going to be looking for what we call the discount array, okay, discount array. And what is this? So, and we have one right here, we have this fair value gap between these candles high and these candles low. Yes, only a single pass, okay, so the market was not feed. This is buy side inefficiency, okay, so the market has to feed this completely, and price, we got our entry here, our first entry here, price came back and take, even the price came back and traced below this short-term low, okay, and into our fair value gap as well. So we got our first entry here, and maybe if you are not bold enough, and this is another, probably another entry for you, your stop loss will be down here. And so you can see price trade up nicely, okay, so that is just how we break down the market to a premium and discount market, okay. Now this is on Wednesday trading for the week we are looking at, okay. So remember we started with on Tuesday, okay, we started with Tuesday. So now we are in we are looking at a brand new day. This is brand new data, okay, and this is the 15-minute chart, okay. So now we already know what this is. Remember, we go into the marketplace doing exactly, or hoping to do exactly the same thing, okay, though price offers price action price action varies, okay, price varies on a daily basis, but the market always does same thing, okay. So this is on Wednesday price action data, okay, for the previous week, which is the week we are currently back testing, and we are still on that same week, and this is on Wednesday data, okay. So now this is 12 o'clock midnight to on Thursday midnight, 12 o'clock, okay. Now this is 2 o'clock a.m. to 5 o'clock a.m. for London session. This is 7 o'clock to 12 o'clock, okay. Now as you can see, we already have our directional bias in mind, and we know that we are bullish, okay. So we are looking to buy, we are looking to buy this, we are looking for buy entry only. And remember, our high probability setup for the day is always below the candles opening, okay. We are always looking for high probability setup below the candles opening for bullish days, okay. So now we have the opening candle that opens up this Wednesday trading, okay. Now price trades down below it, price trades down below it, and trade down, created a kind of support, trades upwards, and trades below this the support level. Remember, if we are expecting higher prices, what should we see? We should see price trades below a short-term low, taking out sell side liquidity. And our high probability setup is that we want to see this happen below the opening candle of that day, okay. so that will give us a high probability setup, a high probability entry. Okay, so which is what we are seeing here right now. This is the opening candle for Wednesday, and price is below it, and we just went below an old short-term low right here. Okay, so now we have a possible entry, signal right here for a buy setup. Okay, so let's just see how it goes. Let's go down and do some markup. Okay, so now this is that same 15-minute time frame with markups on it. Okay, so we can see price went down below a short-term low and grabs liquidity. Now price started trading upwards right here, so we pretend that none of this whole move has happened yet. Okay, none of this whole move has happened yet. So price went down below this old low and grabs liquidity. So what we do, once this happen, once price grabs liquidity on the 15-minute chart, once price trades below an old short-term low to take out sell side liquidity if we are anticipating higher prices. Okay, remember, if we are anticipating higher prices, we should see some level of short-term low be taken out, sell side liquidity be taken out. Then if we are anticipating some level of lower prices, we should see short-term highs be taken out. Okay, so now remember, our bias is bullish for the week, and price has just traded below a short-term low, taking out sell side liquidity. So once this happened, once this candle trades through, what we do is to go down to our next intraday time frame, which is the 5-minute chart, the 5-minute time frame. Okay, now this is that same price action. Okay, this is the opening candle for the day, and this is that short-term low on the 15-minute chart. This is price trading below it, so none of this has happened yet. Okay, so now price starts to rally upwards, and take out a short-term high, which is break of structure. Okay, so we have a candles high, we have a higher high and a lower high to the right side of it, which is a swing high, and market broke it. So this is break of structure, so market is now bullish from here. So we can see price trading upwards, and none of this has happened. So price trading upwards and started retracing back inside this trading range. Okay, this low and this high. So now what we see here, what is this? Fair value gap. This is a fair value gap, so we mark it out in time, and once price trades into this fair value gap, into the low below the low of the third candle right here, this is where we'll get our entry. Okay, so price does that here, and we probably went long here. Our stop loss is here. Okay, so now projecting our TP, like I said earlier, what I normally do is I just measure the range of the movement below the opening candle, measure the range, and I duplicate that and set it. It gives me my TP. Okay, but this is one of the ways I get my TP. Okay, so now this will be all for our money trade. Okay, like you see, we got our entry here, and we projected it, and you can see even before the New York launch hour, I think we got our order to be almost filled here. So you can just collapse it and be done for the day. Okay, what we are not trying to do is that we don't want to be greedy and hold trades to how am I going to put it? we are not trying to capture the whole daily range, okay? So but what we want to learn how to do is, at least we should be able to get if not 50% of the daily range, okay? So if you are able to get 50% of the total pips on the daily range, that should be enough. If you're able to get 60, fair enough, okay? So we are not actually hoping to get 100% pips of the whole daily range on a daily basis, okay? So you can see that after we got our entry here, this retracement that happened here would have been a kind of you would have seen your profits depreciating, okay? Maybe you would have seen your profits depreciating and likely get tempted and collapse the trade, okay? So that is just another kind of psychology in trading that we need to master, okay? So that comes with some kind of experience, okay? So the more you do it, the more you are going to get experienced, and be willing to hold hard for trades like this, okay? So now let's go deeper, let's see what we have here, okay? So now this is okay, this is the Wednesday's open. I stipulated it here, okay? This is the Wednesday open, and this is that price, same price action here, okay? So price is below the opening candle. You grab liquidity, and I don't take this, okay? Hold on, take I'm staking here, okay? Alright, sorry for that. Okay, this is where we are right now, okay? Price trades, and okay, we are through with this. Let's see, let's go to the next move. This is on Wednesday's opening, okay? This is on Wednesday opening. That action, okay, it's the same price action. This is on the 5-minute chart. Sorry, I ought to show this before I showed us the this is also 5-minute charts. March OCs, same price action. Australia. Okay, let us see what happens here. 5-minute chart, breaks of structure, market trace back. We got our entry right here. Okay, now yeah, so what I wanted to show us here is the Fibonacci. Sorry, I got confused. I wanted to show us the Fibonacci. This is the Fibonacci, applying the Fibonacci, delineating the market to discount and premium market, okay? So now once this retracement starts happening, we don't chase the expansion, we always wait for the retracement, okay? So now this retracement is happening, we are pretending that none of this has happened yet. So once we start getting this retracement, we can take our fib, measure it from the low to the high, and we are only interested in buying below the 50% level, okay, which is the discount market. So what is below the 50% level? The fair value gap, okay? Fair value gap, and we trade into it, and as you can see, this is our entry, and price moves away nicely, okay? Now coming down to the 1-minute chart on that same price action, okay, on that same price action. Now this, as you can see here, is that 15 minutes old low that price traced through. Traced through it, and there's a break of structure right here. Price break structure, trace down. So now once we get this break of structure right here, we start, and price starts retracing downwards. We can take out our fib, okay? Market, we measure it from the low to the high, and we are only interested, remember, we are interested in buy this market or getting into this market in a discount price, okay? So price, what is this? This is a fair value gap, and where is it? It's below, is in a discount market environment, okay? So we get in here. So as soon as price trades below the low of the third candle, so price would have tapped us in here, and we are already in. So remember what I said earlier, if you are able to get your fair value gap in on the 5 minute time frame, on the 3 minute time frame, there's no need of coming down to the 1 minute time frame. Okay, there's no need of going lower than that. I actually added this for the teaching purpose. Okay, so I went down to the 4, I saw nothing. I went down to the 3 minutes, I saw nothing, until I got down to the 1 minute. Okay, and I got this. So now that is how to apply uh, the fib to it, delineating our market into um, discount and premium market. Okay, now this is on Thursday's opening. Okay, this is on Thursday opening and on Friday's opening right here to 12 o'clock a.m. New York time to 12 o'clock a.m. New York time. So this is 24-hour time frame window. Remember, our bias is still bullish. Okay, so we are looking to buy, we are looking for buy entries only. Okay, so now and this is the candle that opened up the day. Okay, so you remember, this should be your time delineation. This is how your chart should look like in terms of trading with time precision. Okay, combining time and price, because that is the only two things that matters in the market, is time and price. Okay, so now price, this is the opening candle for the Thursday trading day. Okay, opening candle for it. We are only interested for our high probability setup trade below the opening candle. Okay, so now price trades upwards, trades downwards, create a short-term low and drop down, taking out sell side liquidity. Okay, so once this happen, we can now start looking for our break of structure and look for probably an imbalance. Okay, so let's go down and let's go down to this has happened. Let's go down, mark up the chart. Okay, so now this is the markup of the chart. We have the opening candle, price trades down, grabs liquidity. So let's go down to the 5 minute time frame. So we are ignoring this whole price action here. Okay, none of this has happened yet. So we are currently on this trading on this candle. Okay, price just went down below a short-term low, below the opening candle for the day. Okay, so let's go down to the 5 minute charts. Probably this is the 3 minutes. That's because I saw nothing. I was not able to identify structure change, market structure change on the 5 minutes, and I probably went down to the 3 minutes. So this is where I got one. Okay, so this is that opening candle. This is the opening candle right here, and price trades below and hold short-term low to grab liquidity. Okay, so this is the 3 minute chart. So we have this short-term high right here. We have this candles high, higher, and lower high to the right side of it. Okay, so now price trades through on this candle, breaks of structure. Okay, price broke structure and just continued expanding higher, and price showed willingness to start retracing backward, downwards, back inside this trading range, because we are looking at this swing high to this swing low to this swing high, sorry. So price started trading downwards. Okay, so now we can look inside this price leg for an imbalance. So we have one right here. uh you can see there's a fair value gap here. So price breaks structure to the upside and waits for the retracement, and it retraces back down into this fair value gap. Okay, and this is where we get our entry, and our stop loss can be here or here, depending on your risk management. Okay, so a safer side will be here, but you can use this short-term low as well. Okay, so let's go down further. Okay, now applying looking at the market from premium to discount perspective with our fib. Okay, so you take out your Fibonacci retracement tool and you draw it, and as you can see, below the 50% level, which is our discount market environment, we have this fair value gap, and price trades into the fair value gap and give us an entry. Okay, as you can see, price moved away swiftly and nice. Okay, now let's going down further. Like I said earlier, I always in terms of setting my TP, I take measure I measured take measurement of the range below the opening candle for the day, and I project it upwards, just like you can see here. And I also take note of equal highs and clean highs as my TP. Okay, so this will be a TP and this will be a TP. As you can see, price got there nicely. Okay, but let us take a look at this price action here. I want you to take a look at something. Okay, so now we got an entry right here on this fair value gap, and if your stop loss was here, you would have been stopped out, probably in loss, or you would have gotten a break even trade right here. Okay, so let's say you got stopped out or you got a break even trade. Let's see how we can, if we can get another entry. Okay, so now I want you to take a good look at this equal lows right here. A good look at this equal lows. Price trace down into it, taking out the sell side liquidity resting below here and also stopping you out. Okay, so now, and notice that price trading below this equal lows also trade below the opening candle for the day. Okay, so let's take a closer look. Now this is that equal low I was making reference to, and price trades down below it. So let's say you were stopped out. Let's say you placed your stop loss here and you got stopped out, or at a break even market. Okay, so let's see if we can get another entry. So now price went down below this old low, and this is the opening candle. Okay, I extended out in time, so I extended the opening candle out in time. Okay, so now price dropped down below the opening candle, taking out sell side liquidity, and there was a break obstruction right here. So the market traded away nicely and never leaving behind a fair value gap which was never filled. So this is our potential entry. Okay, and as you can see, price came back after a long time and gave us a nice entry, filling our order here. Okay, and as you can see, after filling us in, price moved away swiftly. So that is another entry you could have gotten in right here, and probably in taking the range, the whole movement below the opening candle. Okay, projecting it out to 3 arrow. Okay, risk to reward ratio, get 3 arrow right here, and we would have been done with this market. Okay, so this is for on Thursday trading day. Okay, this is for on Thursday trading day. So let's go further. If we would have target this old high, we would have still getting our TP. Okay, so you can see price after getting us in here took out this old high. Okay, and that's a lot of movement. Okay, that's a lot of pips right there. So now let's go to the last day of the week. So we have, this is the Friday's open. Okay, and Friday's close. So now this is the opening candle for the day, and remember we are still very much bullish. Okay, we are still very much bullish. We are looking for buy entries only, and our high probability buy setup is below the opening candle of the day. Okay, so as you can see, price created a short-term low and moved up, came back, bounced a bit and dropped down aggressively. Okay, and dropped down. So we are currently below the opening candle right here. So we go into this little area of price action to hunt for our buy scenario. Okay, So let's go down deeply. Okay, now this is that opening candle right there, and this is price creating a short-term support and trading below it right here. So now we are going to look at this area of price action on the 1 minute time frame. Okay, this is the 1 minute time frame. Remember I said if you are looking for anticipating a buy, anticipating higher price, we should expect some level of run on sell side liquidity. Okay, so let us look at the price action in this shaded area. Okay, let's see what we've got here. Now remember, let's go up. Remember we are below the opening candle for the day, and price is trading below a short-term support level. Okay, taking out the sell side liquidity. Okay, so now this is the area that was shaded. Okay, so we are looking at price action right here. So now price created a short-term low here, and created a kind of double top. So there will be sell side buy side liquidity resting above this short these old highs right here, these equal highs. Okay, so now price did something here. Remember, price is being fractal in nature. Okay, so now price being fractal in nature ran out a short-term low, taking out sell stops on the 1 minute time frame. So same scenario we saw on the 15-minute time frame, price taking out an old low. Okay, price taking out an old low is same scenario we are getting here on the 1 minute time frame. This is because price is fractal. Okay, so what happens on the higher time frame tends to repeat itself on the lower time frame, and we can see that this short-term old support level being taken out here. Okay, the sell side liquidity be taken out here, and price break structure here. Okay, price break structure, and there was no deep retracement either, and the second break of structure occurred. Now the retracement started with this swing high, then we can go into this price leg for our fair value gap. Okay, and as you can see, this is our fair value gap. Price trades into it right here, giving us an entry. Okay, our stop loss will be below this short-term low, and we can aim out for these equal highs and this old high right here. Okay, so this will be our first take profit, and this will be our second TP. Okay, so let's see what we got now. Applying looking at the market from discount and premium perspective. Okay, so now this is that break of structure right here, and price started the retracement right here. So we take out our fib delineating these markets to a premium and discount environment. Okay, so now remember, we are only interested in the discount array when we are looking for buy setups, and this fair value gap is below the 50% level. Okay, and as you can see, price dipped down below the 50% level into the discount market. Okay, before taking off. All right, so that will be our entry right there. Okay, as I was talking about, as our TP was taken out and this old high was taken out as well, and we have these equal highs here, sell side liquidity resting above it was also taken out, and even this old high back here also taken out. So this is a lot of pips, and this happened on the Friday. Okay, this happened on the weekend. Okay, so now that will be this brings us to the end of the episode 1 on the 2022 ICT YouTube mentorship. So like I said earlier, I'm not trying to replace any of ICT's concepts. This is just me sharing what I have learned so far from the free 2022 ICT YouTube mentorship. Okay, which is available for free on Inner Circle Trader YouTube channel. Okay, so a quick summary of what we have learned so far. Okay, so now the weekly time frame, we use the weekly time frame to determine your directional bias, having in mind that price is only drawn to one of two things: stops being liquidity and imbalance, that is to rebalance price. Okay, so we use the daily time frame to identify swing highs and swing lows for liquidity, and to know where you are in the overall trading range, be it discount or premium. Okay, now in 1 hour time frame, we use the 60-minute chart to delineate each trading day of the week at 12 o'clock a.m. New York time. Okay, it also helps to identify the opening candle of each new trading day easily. Okay, so now the 15-minute time frame, we use the 15-minute chart for intraday trading and to identify significant lows or highs taken out as stop ons. And so for the 5 minute, 3 minutes, and 1 minute, we used to look for imbalance after stop hunts on the 15-minute charts, and also for entries. Okay, this is just a quick summary of what we have learned so far. Okay, and I hope you find this resourceful. So I'll be dropping the episode 2 of the 2022 ICT YouTube mentorship. So this is just the series for on the episode 1. Okay, this is just the series on the episode 1. So watch out, and please, if you have not subscribed to this channel, kindly do so. Turn on the notification bell to get notified whenever we upload new content, and I'll be making sure to upload content twice in a week. Okay, twice in a week, every week, and we are going to get to the level of where we're going to be uploading live trades as well. Okay, so I hope that we have a lot in store for this channel, and I really appreciate if you guys can show some level of support by subscribing to this channel as a way of supporting our efforts in creating these videos. Okay, so remember, we are not the owner of the concepts. Melody FS Academy is not the owner of these concepts, and all credit goes to Inner Circle Trader Michael. Okay, so I hope you have found this video helpful and insightful. See you on the next video. Thank you for joining us. See you next time.